Good morning and welcome to GrainTV.
Good afternoon and welcome to GrainTV.
Good afternoon, welcome to GrainTV today.
Cody, what's your favorite number out of this morning's garage of data?
Yeah, I'd say that. Good afternoon and welcome to GrainTV. Today is August 12th. Well, this last week we saw global markets absolutely dominated by volatility. European markets and global markets really took it on the chin. But when the dust settled, Sean, can you tell us what the agricultural markets damage was?
Yeah, we saw a huge swing in those equities, but Cody, grain's faring fairly well here. Not seeing too much volatility compared to previous USDA reports. We saw corn up and right around a dime. Beans actually the only commodity here as far as the grains go, taking a little bit of a shot to it during the week. Finished about a quarter to a cent and a quarter here on the week, and then wheat doing fairly well, picking up a dime to a quarter depending on what contract you were sitting in. So really well here for the commodities, considering the huge swings we saw in equities. Now, Monday and Wednesday were both huge sell-off days in the equities, and then Tuesday and Thursday both huge rallies. In fact, we only wound up down 1% on the week after all those swings. So doing fairly well considering that huge amount of volatility, Cody.
Well, we also had a big supply and demand and production reports on yesterday, and they were really bullish, and we're only up 11 cents for DC corn on the week. So as I look at this, USDA came out and they revised yield down down 5.7 bushels from the trend line yield that they were using in July. We're down near 153 bushels. That puts ending stocks down 156 million bushels, and that means that the stock-to-use ratio is about 5.4% versus 6.4%, which is what we were working with. So the bottom line here is that these are bullish numbers. Now, the one thing that I did notice in the USDA report is that they revised down the demand side of that supply and demand equation.
Mm-hmm.
They took feed and residual, they moved it down 150 million bushels. They took ethanol, they moved it down 50 million bushels. They took exports, they moved it down 150 million bushels. So it's not a very positive view of that demand of this equation.
Yeah.
But in terms of production, not a good sign.
Right. Now, the demand side of things we've actually been focusing on, and throughout the past couple of months here, we've seen slowing demand from our exports. We've witnessed corn, soybeans, all three commodities in the grain complex are really having a tough time getting off our shores, Code. A lot of that, that demand side equation, we're also looking at domestically here. We've seen consumer sentiment down to its lowest levels since the 1980s. And bottom line is, people when they're scared like that, they don't want to buy that high-end steak. Maybe they stick to some ramen noodles and some chicken breasts. So
you're saying that domestic demand actually may be hurt going forward?
Oh yes, certainly. And we also witnessed examples of that in the Federal Open Market Committee statements on Tuesday. What I mean by that is they essentially said they're going to keep rates down low, at historic lows until mid-2013. They're basically telling everybody, listen, we're in an economic slowdown where they're trying to get people to spend money. And what that means to me is domestically, people aren't going to be buying quite as much high-end, steaks, poultry, and hogs. So
yeah.
That's the way I'm looking at it.
Yeah, that's true. And why don't we look at it also from an end user, a hog farmer, or a cattle feeder. Right. I mean, they're trying to feed these beasts, and they were hurt when corn went to $8. I mean, they used up a lot of that excess cash, and I'm worried that if we move up even to $7.50, we're going to see them squeezed again.
Yeah,
and that means that we're going to potentially see hogs. Cattle move the market faster. And it also means that rationing is going to occur. I think even quicker,
sooner, for those higher levels. Yeah, price rationing is definitely one of the situations we're keeping an eye on now. The USDA pretty much came out and said, price rationing is out there. We saw that beginning stocks revision up. It means, of course, people just aren't buying as much as old crop as we had expected. So that's definitely a situation we're looking at. But enough hot air out of us. Let's go ahead and take a look at the hot air coming into the Midwest here. The 8 to 14 day outlook, a little bit warmer than we had initially anticipated for late August here, or rather mid to late August. We're looking at another hot spell come through the Midwest and the South as well, affecting that Western Corn Belt. What that means, of course, Cody, is I'm worried about filling, I'm worried about soybeans at this time of the year. So that's something we got to keep our eye on there. The heat's still causing problems for us. And we're talking about rain here in a minute. We're also going to be dry in the Midwest and on our way down to the south as well. We're only seeing relief as far as precipitation goes up in the northern states there where spring wheat's going on. So
yeah, so it looks like the forecast, when we look at the forecast, it's not as great as we were hoping.
Right.
It's not anything like what we saw in July. But once again, this is a critical time period when we're filling grain, and this could really have a huge impact on yield as well. So, why don't we take a look at the cash basis? I know that we talked a little bit last week and the week before about spot basis and actually how it's declining. We'll take a look at the last 10 days. We've seen a decimation of spot corn in the cash market. We're down 9 cents. And can you see where it was actually down the most? 13 cents here in the eastern part of the Corn Belt. Now, we saw barge rates increase over there. That put a lot of pressure on basis in that region. We also saw ethanol plants. Weakened by as much as 15 cents. Well, average 15 cents. So, I mean, that really is kind of leading that spot corn basis down.
Right.
Take a look at the average across the U.S. This is corn. I didn't put it in the chart, but this is corn spot basis, and you can see how we reached its peak a couple weeks ago, and we've really come off hard here in the last week. So take a look at new crop though. New crop holding its own. It's a different story, and I think this is all. It's shown in the supply and demand report. We found an extra 60 million bushels in beginning stocks for this next marketing year.
Yeah.
That, I think that means that we have plenty of supply, going in.
Right.
And people are worried about.
Another thing I wanted to mention here, Cody, is we spoke about this about 2 weeks ago as far as the carry goes between September and East corn. We're nearing a full carry market here, right around 12 cents. Typically, full carry is about 5 cents a month, so 15 cents between the two contracts would be a full carry. Sitting at about 12 right now. So that was something one of our watchers actually asked a couple of weeks ago for the question of the week. We covered that then. They asked if that spread is looking favorable. Turns out it was. If you're in it right now, not too much room to move. You're only going to get about 3 to 4 cents higher, perhaps. So if you're looking to take some profits, that's probably a good plan.
All right, well, that pretty much wraps up GrainTV for today. If you have any questions, feel free to give us a call. New crop corn is sitting, about 6 cents close to the contract highs. We'll see where it goes next week.
We'll catch you all next time on GrainTV. Thank you for joining us here on the wrap-up.